G'day guys, welcome to Have a Beer, Have a Forex. Today we're going to talk about the way I believe the markets work and hopefully going to challenge a lot of your values. Get you a bit shocked, a bit of a shock rock Forex. Alright, this is the dollar yen, the USD JPY. It's the purest reflection of the US dollar, as it were, on Forex. We're on the 1 hour time frame. I went long the US dollar last week. It was October 9 Australia time, October 8 still. This is Eastern Standard Time or some crazy time that MetaTrader 4 won't let me change. So we've got bottom 1, bottom 2. We had oversold Stochastics. I entered on the 5 minute. That's a different story. And you can see it was off to the races from there. Now, the way you draw in trend lines is you have 2 points, point 1, point 2. You can draw a straight line from there. And you'll see, all of a sudden, for whatever reason, price went down, basically tagged the trend line, just went there, and then retreated back up. Now, why did it do that? That is not random, guys. That is not random. This is a buy area. Okay? That's how trend lines work. Technicals rule the market. Don't come and tell me that this reaction, precisely at this point, okay, it wasn't to the pip, but it's basically spot on, was based on, well, that was based on GDP growth and anticipated investment confidence out of the US sector. Bullshit. If anything, there was no reason to buy the US dollar here because they hadn't resolved the debt crisis, as it were, quote unquote. Why was the dollar yen, the pure US dollar, going up on Wednesday, as of Wednesday last week? And then why did it sell off when the problem was resolved? And this is a beautiful example of the phrase, buy the rumor, sell the news. What rules the market is not what's going on in the news. What rules the market is what are the buyers and the sellers doing. So this is what was happening. We had a low and then a higher low. That signals the start of an uptrend. Hedge funds were buying as of last week in anticipation of a resolution, or if you're a conspiracy theorist, in knowledge of an imminent resolution to occur with the US dollar and the debt ceiling. US dollar went off to the races, went really, really, really high, pushed up from 97, well over 100 pips, to 98.89 high. Now, why did it go down precisely at this point on the 16th of October US time, which is around Thursday night? Why did it just go down here? That's because they sold the news. What the hedge funds and all the institutions did is they pushed up price in anticipation of a resolution. As soon as the resolution came in, all the stupid fundamentalists, retail traders, and punters who still hold on to the news bought. And who do you think sold to them? All the smart money which had been involved since Wednesday. Now, I'm not saying I'm the smart money because I came in and I put my take profit. I've moved the stop loss to take profit under here, and I didn't get this full move. I put it under here, and as you can see, I got taken out. At least it was for a profit, and again, I'm trading on a shoestring. I'm getting my mojo back, getting into a good groove, and trading small. But that doesn't matter. This is about theory here, and this is about challenging everything that people say. Oh, there's an efficient market. Oh, technical analysis doesn't work. You know what's really important? Sigma. Sigma doesn't matter. What matters is what the buyers and the sellers are doing. And really, it's about the buyers. Because if you look at what happened on the flash crash in 2010, nobody likes to talk about that. The flash crash in May 2010, sell in May, walk away. There were no bids. There were no buyers. And if there's no buyers, the price of something goes to zero on the market. So stick that up your pipe and smoke it. And there's a reason people are full-time finance lecturers instead of full-time traders. And that's because they hold on to Stuyot, like the efficient market hypothesis and modeling markets with formulas. Good on you guys. That'll work for a while and then stop working very quickly. And if you doubt that hypothesis, go look at what happened to long-term capital management in the late 90s in the wake of the collapse of the ruble. Let's just say long-term capital management was not so long-term. They're no longer around. They had to be bailed out. Billions and billions of dollars back then. So kudos to the efficient market hypothesis. Right, back here. And now we're going to talk about another really important idea, and that is called divergence. So let's talk about divergence. What happens is we had price, make a slightly higher high here. Okay, poor trend line drawing. Excuse me, I'm using a laptop. And now we look at an indicator, my favorite indicator, the 1433 stochastic oscillator. That's been around since the 1950s. Okay? This stochastic oscillator has been around since the 50s, made by George Lane, I believe was the name. That's longer than a lot of these financial hypotheses. Okay? And this thing works. And this is what the indicator was originally designed for doing. Detecting divergences like this. We've got a higher high here in the price, but a lower high in the oscillator. What that means is the change in momentum, the change in price, and then the change in momentum, the rate of change of the price calculated by the stochastic formula, did not match up. And that's got to give you a warning sign, an amber light. And Daryl Guppy, he's a great Aussie trader, he's got a killer moustache. He said, you could go Google him, go Google image Daryl Guppy, okay, G-U-P-P-Y, Daryl R-Y-L. He calls a divergence a cloaked dagger or a hidden dagger, and you've got to say, whoa, some danger here, danger here. So I saw this and I went, I'm not so happy about this. But I said, well, I've got my take profit here, and if it breaks that, whatever. And I look, at the end of the day, I'm a bit miffed, to be honest. I should have said, amber light, let's pull my stop in really, really close, my take profit, stop profit that is, and really capture as much as I can, but whatever, that was the decision, what's done is done. So this was sell the news. The debt ceiling crisis, quote unquote, has been averted for 3 months till January. Mel Gibson and his evil plan to turn the whole world into a Mad Max set has been pushed off for 3 months to Jan. And if anything, fundamental news-orientated analysis, well, all the investors were saying, well, you know what, the US dollar is going to recover now because we've resolved the debt ceiling issue. No, it's not. They're going to sell the news. The institutions, that's the way they work. They've accumulated here, the smart money one in here, and they sold to all the punters. Stupid Windows 7, Windows 8, short Microsoft, Windows 8 sucks. They sold to all the punters who jumped in here. And the sellers out, as it were, really had the initiative, and you can see that in the OBV, kind of tapered off here. Divergence, that's a get the hell out of that trade signal. So I'm really taking that and internalizing that for next time. And this is a beautiful textbook example of buy the rumor, sell the news. What matters is what the buyers are doing. They're the ones moving the market. Now I admit, I was pushing my hoisin for about 24 hours. I got canned goods. I'm not even joking. I was thinking about buying silver. I was worried for 24 hours about the collapse of capitalism and the economy as we know it. Because I listened to a tiny bit of the news and I went against my grain and said, you know what, look, I can see what's going on in the market. It's going to be alright. But still the news gets you, and it's sensational, it's emotional. The news is there to sell news, to sell advertising on the channels, and to sell advertising in the print. That's all it's there to draw attention, sensationalists. And they're not realists. They don't really know what's going on. They're just bullshit artists, to be honest. So that's the USD JPY. I hope I've challenged your beliefs. I hope I've shown you some seichel, some intellect to technical analysis. This is not hocus pocus. This is market psychology, looking at what the buyers and sellers are doing and how that influences price. GDP doesn't influence price. GDP influences buyers and sellers, who in turn influence price. And believe me, buyers and sellers are stupid. You know why? They're made up of people like you and I, and we are sometimes stupid, we are sometimes emotional, we are sometimes crazy, and that's going to be put into the market. So what matters is, are there higher highs, higher lows, divergences, things like that. That's what's going to move the markets. So now we've broken this trend line. Well, what's going to happen? I think we might retrace to this trend line, get oversold here on the Stokes. If we touch this trend line, I'm going to be all over that like white on rice, shorting it. We see OBV going down. Let's zoom in on the daily. I haven't planned this daily. Look, and I was genuinely worried about this kind of downward wedge, as it were. You can see the big things. We're going to get up here and maybe fall down. We could get as low as here. Who's to say the US dollar has to be up here? We've had a monster run up since January, even before that, end of last year. Maybe let's give something back, have a 50% retracement down to here where this trend line is, more or less, and then we can go off of there. This channel is not ready to break to the upside, it looks like, especially given the declining OBV, declining on balance volume. That's initiative is in the seller's side, and we've got a beautiful daily stochastic crossover I reckon the dollar yen is going to sell off now. We'll get to some more drama, soap opera type things in January 2014. Look forward to it, guys, because there's going to be another beautiful trading opportunity for buying the rumor, selling the news. It's not going to be different next time, let's hope, and maybe I'll finish my baked beans by then. Alright, guys, give it a go. Put your stops in and your emotions out. I hope you've enjoyed this bit.